Do investors need special protection against excessive market risks? Is there already excessive protection? Does this hurt development of markets? And what about the regulators and law enforcement? Are they doing their job properly? We've assembled an illustrious panel of experts and given them an exam question. The exam question's printed in your program. Market integrity and investor protection rules hold markets back from being truly dynamic and innovative. Investor protection in particular has gone overboard and the legal system can't catch the real villains. Discuss. With me to discuss this topic is, starting at the far end, Keith Yeung, Senior Counsel, Hong Kong's Director of Public Prosecutions. Next to him, David Webb, well-known commentator, founder of website.com and currently Deputy Chair of Hong Kong's Takeovers Panel. Then next to him, David Graham, Chief Regulatory Officer and Head of Listings at the Hong Kong Stock Exchange. Next to him, Bill Strong, Co-CEO of Morgan Stanley Asia Pacific. And to my left, Andrew Procter, former regulator in Australia, Hong Kong and the UK, but now Global Head of Compliance at Deutsche Bank. Let me open this topic by asking you, David Graham, is market integrity or investor protection really something that inhibits market development? Or can these concepts complement and balance one another?
Thank you, Mark. Obviously, in the context of listings in Hong Kong, this has been really a topical debate over the last 6 months, and therefore, a very good issue to put on the agenda today. I think in kind of short, obviously, if you take it to its logical conclusion, you would say investor protection and market integrity clearly can be an inhibitor to market development. If you don't have those as the bedrock of your regulation, say in listing, clearly it gives you complete freedom as to how you develop your markets. But I think sensibly, and certainly from a Hong Kong listing perspective, investor protection and market integrity are the bedrock of our legislation here and our regime here, and it is very important we take those into account as we develop our market. So to my mind, it's a question of getting the balance right. If you have too much focus on investor protection and too much, then you're likely to inhibit appropriate market development. Inside the listing regime, we clearly have investor protection and market integrity as being very important to us, really coming out of the vetting regime we have and the suitability override that we have in relation to companies listing on Hong Kong. We're not a disclosure-only regime. I don't think we're ready for a disclosure-only regime, so there is some form of paternalistic approach to it, the way that we do these things. But I do think it's very important, and we talk about particularly investor protection, that this is itself a dynamic concept. It's not an absolute concept. And you have to look as that develops, as your market develops. So what might be appropriate market investor protection, in the past may have moved on, and you need to kind of constantly be evaluating what is the right level of protection, of investor protection that you need for your particular market. And certainly in the listing environment, there have been some developments around looking at, for example, VIE structures or investment companies where we have taken into account market developments in relation to our structure. And I suppose the most recent example would be the joint policy statement relating to overseas listings, where I think it's important we attract overseas companies to list in Hong Kong, and getting the right level of protection so that we have an appropriate regime here, as well as having an efficient regime, is clearly important. So that's kind of where I get to on that.
David Webb, can markets develop with still tight investor protection and market integrity rules in place?
Well, I always dislike the term investor protection. I prefer the phrase investor rights. Investors have a right to information. They have a right to governance provisions, voting rights on related party transactions and so forth. And if you provide a good set of rights, and we're not there yet in Hong Kong and in many places in the region, then you can have a better quality market. Companies willing to sign up to those standards will get a higher price for their stock because investors place more trust in the regulatory framework and their rights and their remedies. For example, a class action system that we still don't have in Hong Kong, not even for goods and services, which was proposed last year by the former chairman of the SFC, in fact, who was running a law reform commission subcommittee on this. The government has kicked that proposal into the long grass. So in the absence of full investor rights, they tend to rely excessively, and the market relies excessively, on the regulator. The regulator has to bring actions for remedies, as it has done recently in insider dealing cases and a couple of others. But the key thing is that I often hear the very unfortunate phrase of striking a balance between market development and regulation. That's a false proposition. They are actually symbiotic. If you have good quality regulation providing rights for investors, then you can improve the market. You're not holding it back in any way. There are some things that are negative to the market development. Some provisions, I think, are not well thought out in the listing rules. For example, the profit targets to become listed in Hong Kong, they are a target for accounting manipulation and fraud. It would be better to just say you must have 3 years of clean audit. We don't care whether you made a profit or not. That's for investors to decide whether they want to buy the stock, but we shouldn't have that target. So I'll stop with those opening remarks. And
what arises from both answers, I think, is the question: does lower investor protection for listed shares mean lower share prices?
I think that the investors are relying on the framework when they invest, whatever that framework is. If it's a poor quality framework, they will pay less for a stock because they have, if you think about it in discounted cash flow terms, they have a higher expected loss from fraud and theft and other kinds of malfeasance on the stocks they're investing in. There is a point to having listing rules. It's to provide a lowest standard for all listed companies and a set of assumptions that someone can make. In Hong Kong, for example, you can assume that you will get 2 financial statements per year, one of them condensed, and you can assume that you get to vote on related party transactions above a certain size. You should also be able to assume that you have 1 share, 1 vote, and not have to comb through hundreds of pages of constitutional documents to discover whether the management has inserted provisions that give them the right to nominate a majority of the board, for example, which would also be a block on takeovers, and that would end up conflicting with our takeovers code, which is very well thought out and is very similar to codes that investors trust in other jurisdictions. So not only do we need to have a set of common standards for all our companies here, but we also need to have standards that are in line with what investors expect in other markets so that they can find it easier to invest across borders.
David Graham, do you want to respond to any of that?
I'm not surprised at David's comments. Actually, initially, for the first 30 seconds, I thought I was about to say, I agree with David Webb, but actually, as we moved on, clearly I wasn't going to do that.
Any reasonable person would, of course.
I think it goes back to really what I said at the outset. I think, to my mind, in terms of the question you asked initially about, do you get higher prices through having good regulation, etc., I think there is clearly an element in terms of what people are buying into when they buy into Hong Kong listed securities, is the confidence that there is a strong regulatory regime around that has been a vetting process in terms of the companies that come onto those markets. And that certainly comes with a premium. Quite what that is, I don't know. In terms of the other things that David mentions, again, it is a question of getting the right level of investor protection and the right level of regulation. Clearly, there will be a debate around what is the right level of the track record period, for example, and David has some legitimate views around that, and clearly we need to make sure we refine those rules as we need to make sure they are capturing the ills that we think we're trying to deal with. So there may be some developments around that. I mean, in terms of, the question, obviously David has written large about the 1 share, 1 vote issue. Again, that goes back to the question of the level of investor protection. I mean, that particular issue has generated a lot of debate in the press around, at the one extreme, innovation, and is Hong Kong not prepared to be innovative, versus, basic level of investor protection. And I think you do have to look at the competitive environment, and you need to assess all of these types of developments against what is right for the Hong Kong market. I don't think there is a one-size-fits-all answer to this. Clearly there isn't. There are different regulations on this topic and a lot of other topics around the world. There is not a consensus on these.
Having raised the one share, one vote issue, David, I do need to give David Webb a chance to respond to that and say something about that rather than avoid it. So, David Webb.
Sorry, the question being?
About one share,
I think
vote.
one share, one vote is a very straightforward proposition. I find myself unusually in alignment with the Institute of Directors in Hong Kong. They have come out and said quite correctly that most listed companies in Hong Kong already have a controlling shareholder who is putting his capital at risk on a one share, $1 basis. Dollars carry votes and not disproportionately. They obviously feel that they have no plans to sell down their family shareholdings in these companies. They're quite happy to maintain the capital commitment they have in return for the voting stakes that they have. We're not going to be left behind in this. The US is really out on a limb in allowing these dual share structures, or in the case of Google, triple share structures, when they discovered that they needed non-voting shares to keep their control. Other markets have pretty consistently rejected this, and even in the States, there's a body of empirical evidence that shows that companies with dual share structures underperform in the long run. Really, dual shares is a misnomer. We should be thinking in terms of second-class shares coming to the market. The good CEOs really have nothing to fear. If they're insecure and don't have confidence in their own abilities, then perhaps that's why they fear the prospect of being removed by outside investors. But generally speaking, there is inertia. You trust your founders, you trust your CEOs, you give them the benefit of the doubt when there's doubt, unless it's beyond reasonable doubt that they need to change, at which point there needs to be a mechanism for the shareholders to change the board. So I think that one share, one vote needs to go alongside very fundamental provisions of corporate governance that we can take for granted when we invest in Hong Kong.
Thanks, David. Let me change direction a little bit and to the issue of unlisted retail products, and there was some discussion about that in the last panel session. Andrew Procter, do you think investors need to be protected from dangerous products, or is disclosure the panacea? And can you frame your response in terms of your experience with the Retail Distribution Review in the UK and the work that's been done in recent times in the UK?
Mark, let me just link the two questions first. In fact, it's interesting that in the context of regulation overwhelming market development outside of the listed area, there are examples where the accumulation of good regulatory ideas has got in the way of market development and growth, and the securitization issue is the clear one, where each of the individual things that were put in place around disclosure, due diligence, capital, skin in the game, individually were fine. In aggregate, destroyed a market. But to your question around disclosure, let's accept for the purpose of this discussion the importance of investors accepting responsibility for their own fate. Let's accept, and I think I agree with what Greg Medcraft said in the previous panel about the challenge of getting valuable information to them in the context of that responsibility. But I think also recognize that the peculiar dynamics of the sales process can overwhelm an investor. Can mean that no matter what the quality of the disclosure is, their fate often lies simply in whether or not they like the person giving the advice. And that brings a responsibility for additional layers of protection. If you like, additional layers of responsibility on the intermediary, because disclosure is not going to be sufficient in that unusual context. That's why, again, as was raised in the previous panel, the new product approval process has been the subject of so much focus and attention in that Retail Distribution Review and elsewhere, why it's so important that a target demographic is identified, but not only identified at the outset, but tracked in after-sales review in the terms of the management information that's gathered with respect to the actual distribution, mystery shopping, etc., to make sure that the target demographic is in fact the one that's being met. That's why there's been so much focus upon the responsibility of both the manufacturer and the distributor to gather management information in the after-sales process, despite that blurring, in some cases, the roles and responsibilities down the value chain. That's why the focus on platforms and the need, again, as was touched on in the previous panel, to delineate those products which, by reason of complexity, or in this case non-complexity, are suitable for sale through distribution platforms. But it's also, frankly, at the end of the day, why temptation has to be taken out of harm's way, and why intermediaries have to be expected to meet much higher and growing standards with respect to conflicts of interest and the inducements and commissions rules that have been introduced in recent years. There are some difficulties around the edges in terms of detail, but broadly they've headed in the right direction. It's why all of the banks and firms have had to focus so much more on the way people are paid, the reasons for which they're paid, why we give so much time and attention to thinking through resisting the temptation to reward people for meeting sales targets in a very linear way, the old style of reward. On the other hand, there are some areas where I think the proposals are going beyond what they really tolerate if you reflect upon their value. And independence as a label is one of those areas where I think there's a certain seductiveness about describing people as independent advisors and equating independent with better quality advice. Whereas I think if you look at the independent model, you very often in reality find that what you get is a breadth but not a depth of understanding and quality.
One of the thoughts that often occurs to me in relation to the retail distribution project and the concentration on the life cycle of a product is, to an extent, it suggests that the regulatory impetus about 10, 15 years ago on good advice has in fact failed. No longer can regulators depend upon intermediaries to give good advice, so instead a whole different regime of regulation has to be invented to compensate for the absence of good advice. What do you think about that?
I think it's more subtle than that. I think it's a combination of an ability to convey what are, at the end of the day, relatively complex concepts in a way that's comprehensible to an investor in what for most investors is a very unusual situation in which they find themselves. It's not part of their ordinary everyday experience. So that the whole dynamic of the discussion is unusual and difficult. And that's why I think if you add that to the fact that at the end of the day, if you have a commission and inducement structure of the kind that we had 10 or 15 years ago, and if you had a reward structure of the kind that we had 10 or 15 years ago, where there was a relatively linear relationship between hitting sales targets and getting paid, that's a toxic combination.
Yeah.
And you add to that, I hope we come back and discuss in more detail later in this session, you add to that the insights of behavioral economics, but recognize the limitations of those insights, then I think you've got to say disclosure isn't enough.
We'll come to behavioural economics in a moment. I just want to stay on this issue about advice. One of the features of many of these mis-selling cases that we've looked at in Hong Kong has been the reliance on disclaimers of liability, exclusions of liability in the fine print. And to an extent, the fine print has only been noticed by investors when things have gone wrong, which is typically the case. And this has really eroded a lot of investor trust or public trust in the market to be able to provide retail investors in particular with good outcomes. That absence of public trust is a real issue, and it's been mentioned by a couple of the panels so far. Bill, you've got some thoughts about this. Would you share them with us?
I do. This is a very important topic for me. If we think about, first, how can we increase the trust in the markets? We first have to understand how and who got us into this trouble. And I think there's been a tendency in the press and by many to assign blame solely to the financial intermediaries. And I think that is dangerous because everyone who was involved with this played a role in it. The way I've often described it is everyone had their hand on their murder weapon. It wasn't regulated properly. The individuals themselves did not really read the documents or understand them well. And yes, there were mistakes made by the financial intermediaries. One of the things we're not talking about in particular, and I would say this is especially in a US context, is that legislation was passed in the United States that provided significant financial incentives for these events to take place. For increasingly larger and larger amounts of credit being given to people who by definition, were uncreditworthy. So a lot of people were involved with this. So I think first, how do we increase trust is to find out, as an individual, I'm still responsible for my own actions. And the legislators need to be extremely careful about what they do. I think that would be step number one, Mark, in my view, because it isn't just the banks and other financial institutions. Now, for our part, in order to increase trust in what we're doing, the industry's done really three things. It's raised a lot of capital. And again, focusing on the US banks as a proxy for those around the world, from the middle of 2008 until roughly the middle of 2013, the US banks raised over $300 billion of capital. That's an increase of about 68%, 68%. Secondly, reducing leverage. And for those of you who are into these ratios, the Tier 1 common, Tier 1 capital ratios, they've increased from something under 10% in 2005 to roughly 15% on average as we sit here today. So a significant reduction in leverage. And then lastly, again, in a US context, this is true in many places around the world, elimination of risky businesses that are inherently risky, proprietary trading you've read about. So I think that from the point of view of the industry, it's made huge strides. Thanks to regulators, I think they're doing a very, very good job in this regard. And so, but the thing I would leave with on this, Mark, is if we think it was solely the result of the financial intermediaries, we are destined to make this mistake again.
Thanks, Bill. Keith, you and I are bookends of this panel, as both of us involved in law enforcement. Yes. I have to ask you, as the principal law enforcer in Hong Kong, what you think is the proper role of law enforcement in helping to restore public confidence.
Suppose before one talks about restoring trust, one needs to know how trust is lost to start with. Based upon a lot of cases that we read, there are two primary problems. One, conflict of interests. Now, say, for example, I go to a bank, I deposit some money into my account, and then the teller looks at my account. I thought that he was my banker, but then he looks at my account and asks, do you want to buy this? And then suddenly I realized that after I bought the product, that when I lost, the financial institution who sold me the product wins, and vice versa. Now, this is not particularly conducive towards trust. And also, there is this problem of things getting far too complicated. As it now stands, the law is already complicated enough. We have the SFO, which is upwards of 400 sections, 700 pages, not to mention the schedules and subsidiary legislation and so on. Products are also very complicated. It's very difficult for consumers to understand them, assuming that those who explain or seek to explain the products to them understand them to start with. Now, so naturally, law enforcement agency and prosecutions have a role to play here. A message will have to be sent that those who flout the law will be prosecuted and be dealt with properly. But on the other hand, there are limits as to what we can do. It is not an offense to sell overcomplicated products. It's not an offense per se to be in conflict of interest unless the whole thing becomes fraudulent. So there are really limits as to what we can do. I suppose there is a point that one has to go back to basic, that complicated products are left to those who can really defend their interests, for those who are in the position to understand, leaving the relatively unsophisticated consumers to take care of their own interests in their own traditional way.
Thank you, Keith. Just now coming back to behavioural economics and the way in which behavioural economics is a means of identifying reasonably reliable consumer vulnerabilities. Now, is there a role for behavioural economics for financial institutions in marketing products to retail customers in particular? David, do you want to?
Yeah, there certainly is, because as long as it's legal, they, like any advertiser of any product, banks and distributors will pitch their products or the products they're distributing in the way that is most attractive to customers. And whether it's including rice cookers and holiday vouchers or something else when you sell unit trusts, which has now been banned here after Lehman, or something else. So it's up to the regulator and the legislature to impose restrictions on how far you can go with those kinds of promotions that play on human psychology. For example, in advertising a unit trust or mutual fund that did very well last year, and it just happens to be the one out of the 20 that you produced that did well, you ought to have to mention the average of the whole 20 and not just that one. There are prescriptions that regulators can make without being overly prescriptive to try to limit some of these natural tendencies otherwise to try to exploit human nature. But I think that there has to be a very clear understanding given to anyone who talks to a product salesperson that they are a salesperson, they're not your advisor. They can't be both, in my view. You can't have someone sitting in a bank on commission, or the bank's on commission, saying, we are your advisor, trust us, this is the right product for you. It has to say instead, I'm not your advisor, in very clear print on the key fact statement. You are on your own, and read the statement. If you don't understand it, don't buy the product. I mean, there ought to be a few simple sentences of rubric in every key fact statement that makes it clear. In bold print, yes. And you don't get something for nothing. There has to be an understanding there, because too many of these products are wrapped up in terminology that makes people feel there's almost no downside. Bond, for example, or capital guaranteed, without mentioning that it depends on the credit of the guarantor. More disclosure, more awareness. It's interesting that we're talking about this on the day that the coming tsunami in China, I think, is just beginning to emerge, and that is 10 trillion yuan, about 1.7 trillion US dollars worth of off-balance sheet financial products, trust company products sold through banks in China. The first one is likely to default at the end of January. And there's already been, I think, a workout with the provincial government and ICBC on bailing that one out. This is the forerunner of things to come, because in the end, even in non-democracies, particularly in non-democracies where your mandate really depends on the acquiescence of your people, you're going to have to stand behind the banks, and the banks are going to have to stand behind the products they've distributed, even if they didn't explicitly guarantee them. So I think we're going to be seeing a lot more of this. It really feels to me like the very beginning in 2007 of the global financial crisis, when the first fund, I think it was a small Bear Stearns fund, ran into difficulties. I think we're going to see a lot more of that. So it's very opportune that we're now talking about how these things are distributed.
All right, David, moving back to behavioural economics, I think you've got some practical cautions, Andrew, about how far this can be taken.
Well, let me just say I agree with what David said about behavioural economics, and I think we have to get beyond the traditional response to a mis-selling scandal, which is piling ever greater levels of disclosure on the market. I also welcome behavioural economics because it's made regulators' speeches more interesting. But there's something very compelling about the anecdotes that emerge, and it's important that we don't lose sight of the insights that are available. But it's actually very difficult sometimes to translate those insights into clear expectations, let alone regulation. And I was a regulator, you've been a regulator for years, Mark. We've both, I'm sure, over the years been accused of the wisdom of hindsight. And I think when you add behavioural economics into the mix, the danger of hindsight judgment in the event of actual loss becomes even more acute. And my favourite example actually is one that Martin Wheatley, late of this parish, likes to give, where he talks about the fact that you, as a matter of behavioural economics, can demonstrate that you can charge a higher interest rate on a personal loan if your promotional material includes a photograph of an attractive woman. Now, that may well be true, but I sit there and think, what am I supposed to do with that, Martin? How am I supposed to deal with that in terms of my behaviour? Now, it may be that I have a photograph of an ugly man, but in all seriousness, the clarity as to what comes out, in effect, a recognition of the limitations of the science are important. This is almost an item of regulatory fashion at the moment, behavioural economics, and let's recognise it for what it is. It has an element of science about it, but it's not a perfect predictor of behaviour, and it doesn't give absolute clarity as to the expectations of an intermediary in that context. So that would be my note of
All
caution.
right, okay, that's, I think that makes a lot of sense. Can I ask a slightly related question, but something that really goes to the heart of, I think, what a lot of concerns are about investor protection, that the notion of investor protection creates too much moral hazard, and that it creates disincentives for investors to actually look after themselves and take responsibility for their own decisions. Bill, do you have any views about that?
I have a couple, I do. I think first, investor protection rules are fundamental to, I think, the successful operating of a dynamic market. We have to have them. They have to be vigorously enforced. But I think not here. I'm going to pay you a compliment. Not too many compliments, but today one. In certain jurisdictions where there's tremendous political pressure, I think we're getting dangerously close to a situation where the investors have a win-win situation, where they ask for, and in fact, demand for the capital to be back simply because there was a loss, simply because there was a loss. And we can't get into a situation where effectively they say, you know, heads I win, tails the industry loses. So it needs to be a balance. And I think Mark and I were chatting earlier about this. He spends a significant amount of time eliminating cases where it's simply that, trying to find a way just to recoup money where I made a bad decision. If we can separate those in an intelligent way around the world, then I think we'll be in very, very good shape. But when political pressure comes to bear where we're looking for a guilty party, even if there's no guilt, I think that's a dangerous situation.
Thanks, Bill. It certainly...
Mark, let me make one other comment too that I forgot to mention. I think too, there's somewhat of a moral hazard. We talked a little bit about this earlier, somewhat of a moral hazard involved. If I'm an investor and I think there's a high probability I'm going to be bailed out no matter what happens, I think I can do that. What do? I probably take on increasingly unreasonable risks because it's a one-way test. If it works out well, terrific. If it doesn't work out well, I'm going to get bailed out. And so I think if I were a regulator, I need to have balance and need to have my constituents know that if you simply make a bad investment decision, we're not going to bail you out.
The irony is in Hong Kong, in the financial crisis, no banks failed, unlike, say, the UK. But we did have investors who needed help. And we didn't see that so much in the UK, because I guess banks got protected and ring-fenced, depositors and creditors got bailed out through what was done. And what that meant in Hong Kong is that the perception was everyone was getting some money simply for asking for it, when in reality there was a very careful gradation, and we were only able to do things for people where there was we could establish misconduct, and the other party could see that there was misconduct, so therefore they were going to make it good. And I think that's created misconceptions that investor protection is, as you say, a win-win no matter what the outcome.
It should be protected against unscrupulous practices.
Correct.
But not be protected against losses that they themselves knowingly took.
Correct, yes. This really moves us into the third area of our topics, and we have to talk about law enforcement and the perception that some people have that law enforcement isn't able to do all that it should be doing, and that some of the current outcomes from the financial crisis are perhaps creating more cynicism about the legal process than actually confidence that the legal system is fully equipped to do the job. Can I start with you, Andrew, because you've been a regulator and a law enforcer, but now in your capacity as global head of compliance at Deutsche Bank, you've got the other perspective. What is your view about the way in which law enforcement agencies around the world have dealt with issues arising from the financial crisis?
Well, there doesn't seem to be any shortage of action, or in terms of the level of penalty. Certainly as they've emerged over time, they've been enormous, unprecedented. I think the gap, and the important gap, has been around the accountability of individuals, at least insofar as they are dealt with by the regulatory authorities. In fact, of course, if you look across the piece, huge numbers of senior executives have been forced out, their careers have been destroyed, and the personal level of accountability in that respect has been high. But you see a change over time. Just take the US as a proxy for the rest of the world. The old notion of settlements without admissions is disappearing, thanks to Judge Rakoff. You have the insistence in the libel settlements in the US upon some inclusion of criminal sanction attaching to at least one of the corporates in the group. And I think increasingly you have this sense of frustration that individuals are not being held personally accountable for conduct. Now then you get into what's always been the difficult area of bringing individuals to account for decisions taken in what's a complex organization where there's a matrix of responsibility. And the way in which, and that hasn't been solved yet, and it remains a source of frustration, albeit that people are being forced out, as I say, as a matter of fact. And the way in which regulators are starting to deal with that is interesting, to use a neutral word. So you get a greater expectation around prescriptive and exhaustive job descriptions. You get a much greater insistence upon the use of attestations at senior levels. And I'm sure the expectation is that next time you'll be able to look at the job description and say, well, actually, that was Ashley Older's responsibility. He's now accountable. And unless he can demonstrate that he delegated it to Mark Steward, he's toast. And it won't be like that, of course, because that isn't how banks operate. You know, the reality of delegation within a bank, and I'm sure it's the same at Bill's, is someone says you need to do that, or we've got a problem, let's all deal with it. And so I don't think it will become anywhere near as simple as this theory would suggest. And on attestation, unfortunately, and we've seen it most recently in the revised Volcker rule, where the chief executive or that person's proxy has to certify that the bank is able to meet the rule. That's causing a dysfunction of a different kind, with responsibilities being pushed down and certification. In effect, they're repeating the mistake of SOX, which didn't lead to greater levels of accountability or clarity of roles and responsibilities. So tough. I think it's not a problem that's been solved, and I don't think the current approach is going to solve it either.
It raises an immediate question for me. Is that over-regulatory prescription occurring because, in effect, traditional law enforcement has failed?
Well, you could say that, Mark, but to hold someone accountable for a criminal offence is a very, very serious matter. You've got to have very clear, compelling evidence, proof beyond reasonable doubt. And that's not easy, and it's not easy in a complex organisation where the reality is you do have shared responsibilities. So, yes, you could call it failure of a sort, but the world is difficult, and it's a big call to hold someone accountable to the criminal standard. The
corollary to that question is, are these mechanisms designed to create liability because, in fact, investigatory agencies failed to find the fraud that people hoped to find as a result of the financial crisis?
Well, I mean, over the last 15 to 20 years, there have been a series of scandals and failures, Enron being one, WorldCom, etc., which led to waves of additional regulation. I'm not aware, in fact, in any of those cases, there was a gap in the law. There was no problem, actually, if you were able to demonstrate on the facts that a fraud had occurred, you could have done it on the existing law. It's just really tough, as you know from experience.
It assumes that there's fraud.
And yeah, it does.
Yeah.
And you know, tactically also, to get through a case, regulators have historically quite reasonably made the judgment it's better to deal with the corporation, get that person off the platform, compensate people, and move on. Now, you can say that there's a flaw in that because there isn't that criminal accountability at the level of the individual, but that just takes you back to the same starting point of the difficulty of proof.
Bill, I need to ask you this question as well, because one of the feeders of, I think, the cynicism about some of the outcomes in recent times has been the perception that these large fines that have been imposed through agreement with the institution has budgeted for the fine, and what has been imposed, in fact, equals what has been budgeted. So it's almost a payment of go-away money rather than traditional law enforcement.
I don't even like the premise in this question, Mark. I think first, with respect to I think everyone would know this, but with respect to litigation outcomes or fines, they're real. they're painful, they do serve as deterrents, no question about it. Secondly, these types of arrangements are not budgeted. For those of you who are accountants by background, if you know the rules around this, the liability before it can be recorded has to be probable, has to be measurable. And unless those two standards are met, you can't record it even if you wanted to. So what everyone does is that they have an issue like this, and it does get to the point where it's probable there's going to be a fine or probable there's going to be a litigation loss, and it's reasonably measurable. You then work with your outside auditors and you record it. So I think this cynicism, frankly, is just misplaced. It just doesn't work that way. I mean, for our part, every firm has made mistakes. If we've done something wrong and we know we've done it wrong, our view is to settle it quickly and admit that we've done wrong. If, on the other hand, someone is accusing us of something we've not done, we're going to fight it. We're going to fight it as long as we need to fight it. And so the suggestion that this is all kind of done in a smoke-filled room and it's negotiated is just not accurate.
Yeah, thank you, Bill. This brings me to I suppose the SFC question about law enforcement here, and it's I'm going to ask you, David Graham, because you also have a quasi-law enforcement role through the listing division. Deterrent sanctions traditionally involve the wrongdoer, and it's some penalty imposed by a regulator or by the government. Yet it's in our market, it's the investor and it's the market generally that bears the real cost of misconduct. What do you think is the role of remedial sanctions against wrongdoers to deal with the wrongdoing itself as a complement to the normal deterrent sanction?
Yeah, and I think it's a good point. I think you've got to see for example, the listing rules and the sanctions we have for breach of the listing rules within the kind of greater kind of quilt of remedies which are available within Hong Kong. You've got to see them against the sort of the legal background and also the SFC's sort of regulatory responsibility and your enforcement powers. So, I mean, as people will be aware, obviously the listing rules themselves, they're not a statutory set of rules, so our remedies in relation to breaches of those rules are naturally limited. And what I think we're focused on in terms of our deterrent sanctions, which are largely reputational around public criticism, and our remedial sanctions, which are around putting compliance advisors in or external professional parties to effectively monitor compliance with the relevant listed companies over a 1 or 2 year period. They're all really about improving, I think, the standards of market conduct rather than punishing the particular individual in that particular case. If there is very serious wrongdoing, in reality, our sanctions are rather limited, and we will hand it over, as you know, to the SFC to pursue either fines against the particular individuals or worse in certain cases, or to provide monetary compensation if that is permitted to those who've been affected by it. So I see our sanctions partly being, yes, there's a penalty for the individual company, a reputational hit, which may affect their share price. But it is all about, in reality, improving education, knowledge of the market, and improving the standards of the market. And I think in that context, the deterrent remedies that we have go hand in hand with the remedial remedies that we had, but without the buttressing of the law and the buttressing of the SFC when we need it. I think it would be a slightly ineffective regime, to be honest.
To turn to you now, Keith. I think Andrew has talked about the gap between the perception of wrongdoing on the one hand that the community might have, and the difficulties in actually proving cases to the criminal standard of proof. Can you perhaps comment on the criminal decision-making process and the necessary public policy and cautions involved in that process?
Yes, as Andrew has said, criminal prosecution is a very important process. And in particular, we also recognize that the process in itself can wreck career, can wreck lives. So before deciding whether to prosecute, we'll have to consider the evidence as to whether the evidence is such that a reasonable prospect of conviction can be obtained. And then having considered that, the next step will be for us to consider the public policy considerations and public interests. Now, there are a lot of things that can be said here. One, as I said earlier, can prosecution be used and be resorted to restore public trust that has been lost? And also, the fact that a large group of investors might have lost money, do we institute prosecution as a result and because of that, and so as to get even for them? Mark, we try to make a distinction between, as said earlier, the remedial functions of the law and the penal function of the law. In terms of the remedial function of the law, that is recognized by our Securities and Future Ordinance and also recognized by our top court. That is primarily a function that your commission can exercise under Section 213 of the Ordinance. But in terms of penal, it's something very different, and we are there to punish those that have done wrong. So in terms of prosecution, Mark, you'll have to keep investigating, refer more cases to me. And as and when, of course, I will knock back some. But on the other hand, as and when the appropriate cases come, surely they will be prosecuted.
Yeah, good. I'm glad to hear that, Keith.
Perhaps I could jump in.
Yes, David, yes.
For Keith, your predecessor wrote to the papers and said that there was no case that had been referred by the SFC to the DOJ that was worth bringing to the district courts or higher in the last, I think, 3 years of his term. Now, is it the case that the market is just so well behaved that there is no case worth prosecuting? Or are there not some cases that, for example, a company that didn't disclose its hold in the balance sheet over its Australian dollar accumulator contracts that I wouldn't have bought, aren't there some cases where action should be taken and there should be prosecutions? And do you perhaps have a fear of failure in the courts that you want to be 90% certain of conviction rather than 80% certain, for example?
So Mark, is this orchestrated that he's...
No, Keith, in fact, let me, it's not orchestrated. There's a question from the audience that is...
I'm sure you're all wondering the same thing.
Can I suggest, rather than answer David's question, the question from the audience is, there were reports last year of tension between SFC and the former DPP. What is the current position? So maybe that's an easier question to answer, rather than one that involves cases.
I'm sure whatever discussions there have been, the purpose was to improve upon the system so that we can have a more responsive and transparent system. And in fact, I'm pretty sure that my predecessor and Mark have been good friends, and in any event, Mark and I are good friends. Now, that's that. But in terms of David's question, there has been a practice of cooperation between the SFC and the DOJ. Now, when it comes to, in particular, market misconduct offenses, the SFC will investigate the cases and then bring the files to us. And then we'll consider, one, whether to prosecute, and secondly, if we are to prosecute those cases, the venue of trial, i.e., whether they are to be tried in the magistracy or whether they are to be tried in district court. So, David, there are two points here. One, whether there were any cases worthy of being prosecuted. And secondly, quite a distinct question, whether there are cases that should be tried in the district court. Now, when it comes to the venue, the choice of venue as to whether the cases should be tried in district court, a lot of considerations will have to be taken into account, and in particular, the likely level of sentence upon conviction. Now, if based upon prevailing tariff of sentences and based upon cases that have been tried and sentenced before, that the prosecution is of the view that upon conviction, the sentence will be within the jurisdictional limit of the magistracy, then the magistracy can be picked as the proper venue. So that does not mean that the case or cases are not to be prosecuted. It's just that the case or cases will be prosecuted in a particular level. So as it happened, and if the statistics show that during a particular period, more cases are tried and prosecuted in a particular venue, that's that. Those decisions would have been made based upon the considerations that
Don't you need to leave some flexibility, though, for the possibility that during the course of the case, the findings will be so adverse that they are beyond the reach of a magistrate's sentencing powers, which I think is 3 years, and that you should actually allow some headroom above that and send cases to the district court to allow a range of possible sentences depending on the gravitas of the final findings?
No, of course, our criminal system is that before we prosecute, we try to understand the case as much as possible. And also, one of the very important duty on the part of the prosecutions is to make full and frank disclosure of the whole case so that the defense can properly prepare the case and to defend their interests. Now, there is always a possibility of a case changing complexion, either becomes much more complicated, much more serious, or much less serious. But then nonetheless, we try to anticipate those circumstances. If we ultimately, having considered the full facts of the view that a particular venue is correct, then we would have built in the necessary cushion.
Well, I would just say that my observation as a bystander in all of this, and hopefully never as a participant, is that the ICAC has been more vigorous in its prosecutions. It only needs to have a suspicion of corruption in order to then pursue a case that isn't involving corruption. And quite a few listed company corporate crimes have then been taken to the district court by the ICAC when perhaps they should have been taken by the DOJ using other laws.
No, of course, the ICAC and the SFC, in terms of ultimately the decision to prosecute, is appoint the prosecutions, appoint the Department of Justice.
Can I perhaps address this issue a little bit differently? I mean, there are absolutely differences of opinion with the former DPP about the merits of cases. But with Keith now as DPP, we have someone who has general experience in criminal law practice from both sides of the fence, both prosecuting and defending. And I think we have someone who has direct experience of markets cases as well. So I think the dialogue now with Keith is remarkably different to what it was, and that will be for the better. And that's already having substantially improved relations now between SFC and DPP. And I don't think we'll be seeing anything like what was made public a few months ago. So I think we have a lot of confidence going forward. What that brings me to is another question that arises out of some recent events. We've seen Hong Kong, Keith, in recent times participate in extraditing someone back from Hong Kong back to Australia to face insider dealing charges. And previously Hong Kong has also participated in extradition requests for people to go back to the United States. Will we see a case in the future, do you think, where Hong Kong would seek extradition from a foreign jurisdiction to Hong Kong for someone to face insider dealing or market manipulation charges in Hong Kong? Yes,
Mark, you mentioned insider dealing and other market misconduct offences, market manipulation, price rigging, false trading. Now, of course, those are extremely serious offences, carrying maximum sentence of 10 years and a maximum fine of 10 million. So when Hong Kong receives requests for assistance from other jurisdictions for surrendering of fugitive in respect of these offences, so long as the proper mechanism and proper treaties are in place, of course, Hong Kong will assist. And vice versa. When appropriate cases arise, if Hong Kong make those requests, and so long as the proper treaties and mechanism are in place, I see absolutely, Mark, no problem in principle or otherwise that Hong Kong will make similar requests. Now, it's just, as I've said, and I repeat that, you keep investigating, and in some time, there will be suitable cases. And also, may I also emphasize this, that the fact that in recent past, there might not have been any request from Hong Kong does not mean that as a matter of policy, that there won't be. As said, these are serious offenses, and as a matter of fact, between Hong Kong and many foreign jurisdictions, and if I recall correctly, 18, there are already in place proper surrender agreements. And in some of these surrender agreements, specifically, trading in futures and securities offenses are within the scope of these agreements. So, and I can name some of them: Australia, the United States, Sri Lanka, Germany. So when the cases come, there can be. But Mark, I can't promise you you'll take the initiative.
I think one of the problems...
It's a very fair answer, Keith, thank you.
Well, one of the problems, though, unfortunately, is that we don't have a lot of Sri Lankan listed companies here. We do have more than half of our market cap from China, companies managed and controlled from China with very little presence in Hong Kong. And we don't have an extradition treaty with mainland China, do we? So the reach of...
By definition, we can't have
extradition
treaties between Hong Kong and China.
I hesitate to use the word rendition because it has other implications that,
sometimes use the term surrender.
But there isn't a surrender agreement with the mainland. That's
nonetheless, I think the real issue, I think, is that well over 50% of turnover in Hong Kong is coming from overseas. We have a number of extradition treaties in place with most of those jurisdictions, and so I think it's important that there be a level playing field in the application of market misconduct offences in Hong Kong, so that they're not only applied against people who happen to live here, but they can also be applied against people who are using Hong Kong's market from a place overseas. And I think that's the message I think that Keith is giving, that in an appropriate case where there is a treaty and the case merits the resources involved, that will be the case. And I think that sends a very, very strong message. Look, we've come to the end of our allotted time. I know everyone is waiting for lunch, so can you please join me in thanking this panel? Thank you.